picking up good vibrations.
Hi everybody, Alex Deploy here from Expert Forex, and in this video I ask you the question, are you a Forex trader, are you a gambler, or are you an investor? And the answer to those questions will make you a very, very rich person. But you do have to be honest when you answer those questions. So let's have a look at that in a little bit more detail. So on your screen you can see some accounts that you can link to in our linked account service, and they have been recently updated, as you can see there. And the question now is, how many of those results are as a result of gambling, and how many of those results are as a result of an investment approach and is based on true Forex trading or indice trading? So to give you a bit of a background as to those views, let's have a look at this chart that's on your screen right now, where it is basically a chart of a return on this axis and risk on that axis. And essentially that red line represents your return on risk. So in other words, when your risk is low, your return will be low. If your risk is high, then your return will be high. That's the concept shown in this particular chart. However, if your risk becomes too high and your return becomes too high, you may incur a blown account. So this is a very delicate balance that you've got to work with to get your return on risk ratio just perfectly right, so that you don't blow your account. Now, in general, if you are happy with low returns and low risk, which most investors are interested in because they are in the market to trade for the next 2 to 4 years. They have an investment approach. They want to invest their money in this particular strategy, and they want to see a return over the next 2 to 4 years. Now, those kind of traders are happy with a low risk, low return strategy. However, if you are really desperate and you want to make money very quickly, you have to risk more for a higher return at the risk of you blowing your account. So what I've done is I've drawn a green line here which says anything below this line are investors. They are happy with a lower risk, lower return approach. And anybody above this green line, they are gamblers, because they are gambling for high returns and high risk, and the consequence of a potential blown account. So that is the concept that all traders must bear in mind when they trade a particular strategy or they link their account to a particular account. Now, just to give you some guidelines about that green line, essentially the green line says that a return of between 30% and 90% a year per annum is a reasonable return if you want to look at this market as an investor. That means a return of 3% to 9% per month. So then if we look at the list of linkable accounts that we have available in our linking service, we then say, okay, if 9% is what investor will be interested in, anything above that is high risk, high return, and falls into the category of gambling. So that relates the concepts to something that's actually happening right now. So as you can see in the investment group, we've got some accounts that have traded 250 days, 238 days, long accounts that have been trading for a long period, and these monthly returns are therefore pretty stable. Whereas here we have some ridiculous monthly returns of 200% and 100% and so on, which are obviously high risk and high return. Now you have to take those factors into account when deciding which accounts you're going to be linking to. So now, why do most traders trade as gamblers? And there's many reasons for this. I mean, I was once a gambler when I started out, and that is Firstly, when you start out, you have limited capital. Let's say you start out with a $500 account or a $1,000 account, and you have limited capital, and growth of 30% on that over a year. Let's say a $10,000 account, you're only going to earn $3,000. So that's not enough to become a professional trader and so on. So what people do is they have to become gamblers, and they have to incur higher risk with their trading so that they can have a higher return and hopefully double their $1,000 or $500, double it over a year. But again, $500 over a whole year of trading is sometimes not enough, and that's why I say that most traders are forced to accept higher risk and higher return strategy. The other reason is that pure lack of trading experience. Most traders come into the business looking for a strategy with entries and exits. They forget about risk management and position sizing, which are the most important factors to master before you can become a long-term trader. So they don't focus on that at all. They just focus on what kind of success rate I can achieve with this particular system. Then marketing results that get advertised in YouTube and all over the web do encourage traders to expect high returns from high risk. There's nothing spectacular to market a system that only does 3% a month. So marketeers tend to stress the high risk, high return strategies. And that all of that results in unrealistic expectations. People come into the market with a $500 account and expect it to turn into the proverbial $1 million in a year's trading. And because of their expectations regarding risk return and the marketing hype that sometimes occurs behind some of these trading strategies. And then there's the dream. Again, the dream is related very much to the unrealistic expectations. They want their $500 to grow into $100,000, and that is the dream, and they are chasing that dream, and they don't realize in the process of chasing their dream they're exposing themselves to excessive risk to achieve those high returns required to provide that kind of growth. And then many traders do not appreciate the investment concept, the concept that we're in this game for the next 2 to 5 years. We're not interested in these hype incomes. We're interested in a solid income that will reduce our risk of a blown account. So there are many reasons why traders are naturally gamblers without even knowing it. So how do we move from a gambler to an investor? And to understand that, we need to have a look at investors. Investors, firstly, have capital. They have lots of money to invest. So you can't call yourself an investor if you only have a $500 account. Investors generally have lots of capital to invest. They are investors in the true sense. They are very happy with lower risk and lower returns because they understand that that reduces the risk of a blown account and unexpected drawdowns. They tend to trade portfolios to spread the risk. So in other words, they don't put all their eggs in one basket. What they would do is they would most probably trade 5 to 10 strategies that they would follow. And how that then works is that if one strategy has a drawdown, the others will then help with that drawdown, and in fact the portfolio might not even show the drawdown overall. So they realize that by trading portfolios, they can spread their risk. Trading portfolio also reduces risk by the instruments that you can select. So for instance, they never expose themselves excessively to the US dollar or the yen or any of these currencies. They spread their risk over all the 8 major currencies. Investors are very skilled at position sizing. So they know that position sizing is the balance between high risk and high return. So if they sense that the risk is too high, they lower their position sizing. As simple as that. If they feel that the risk is too low, they increase their position size. So they have worked that very sensitive setting on your strategies. They have worked that one out to perfection. They're also very skilled at risk management. Now, risk management involves a whole lot of issues, and my next video will be addressing them. But risk management doesn't only revolve around position sizing, it revolves around choosing the right instrument to trade and analyzing the history of the trading strategy to make sure that the exposure to drawdowns and unexpected events cannot be that dramatic. So there's a lot behind risk management other than just position sizing. And the other thing is they have confidence in their strategy. They have tested, back tested, and demo traded their strategy so that at the point when they are ready to go into live account trading, they have confidence in their strategy. So we go back to the graph that I showed you earlier, but this time we say, what would it take to move this green line that you see on the chart? What would it take to move it up so that as investors we can earn higher returns and with higher risk without the immediate risk of blowing your account? Again, if we look at the list of linkable accounts, that means that the red line that you saw in the previous one can move up considerably, and now a lot more accounts can be considered for investment purposes rather than as gambling. What a lot of investors also do is they balance their portfolio in terms of investment instruments and gambling instruments. So what they might do is they might have 5 investment instruments that they can rely on, and then they might choose one gambling instrument that increases their risk and their return but doesn't expose their whole portfolio to a gambling profile. Now, in one of the next videos, we're going to be asking the question, are you chasing success or are you on a treadmill to nowhere? And it's amazing how many traders are on this treadmill to nowhere. And again, unfortunately, it's human nature that has put them there. And I'm going to point those factors out that get you onto this treadmill to nowhere, whereas you could so easily be a highly successful trader if you change just a few things. And I hope you've enjoyed this video, and I hope you've learned something from the approach of being an investor or a gambler and how you can manage those profiles and become more of a long-term trader rather than a speculative gambler. Please watch those future videos, which will give you a lot more ideas on how to manage that particular situation. So from me, Alex Deploy, cheerio.